you're buying a house today through financing, you'll probably shop around, find a lender with low rates and low fees, and create a new mortgage. However, if you are eyeing a house that actually has an assumable loan with it already, it's very possible that you go ahead and take over that loan or assume that loan and save a considerable amount of money if that interest rate is actually quite a bit lower than today's prevailing rate. Yeah, yeah, it's entirely possible. Even better, not only can you assume the interest rate, but you'll also be assuming the repayment period. And I'll talk about how important that is in the next video. But as wonderful it is for buyers, imagine a seller. If a seller today that has a knowledgeable listing agent, hint, hint, if a seller today has an assumable loan, say at 3%, and that assumable loan was marketed as part of the sale, buyers today would gladly pay a little bit more money for the home with the ability to go ahead and take over a 3% rate rather than pay, whatever today's rate may be, 6.5. Okay. It would be far better to assume that loan. So appreciate that assumable loans are good for buyers and they're good for sellers today. So what loans are assumable? Well, it's kind of easy, really. Pretty much all government loans are assumable. So, for example, an FHA loan is assumable. So, all you need to do is just qualify for it. Yeah, that's right. Just like as if you were going to qualify for the one that you were choosing, you actually don't have the choice. You need to go back to the lender that originally wrote the loan, the seller's loan, if you will, and then go ahead and qualify under the same underwriting standards as the original loan. You get approved today for a loan that actually was originated many, many, many years ago. It's pretty cool, actually. The notion is that once you're approved, you can, above board, take over that loan, and that allows for the seller then to be completely and legally released of that loan. They can go on and create a new loan for replacement property in the future, which is fantastic for both parties. Absolutely. VA loans, another government loan, is entirely assumable. It's somewhat unique because VA loans, the original VA loan, had to been through a vet or a spouse or a person that would be qualified to originate under the VA guidelines. However, the VA does allow for non-vets to assume VA loans. Yeah, yeah, they do. There's a subtle issue here, and I wanted to go ahead and point it out. The original vet used his entitlement or her entitlement benefits to qualify for that, and those entitlement benefits are attached to that loan. So if a non-vet assumes a vet's loan, then that entitlement benefit remains with that loan. The vet cannot take the entitlement benefits with them and buy another property down the road. It's only when the home is sold or the loan is paid off that those entitlement benefits would again become available for that original vet. On the flip side, a vet can assume a vet's loan, and if that vet that is assuming uses his or hers entitlement benefits and replaces the original vet's entitlement benefits, then that original vet can then take their entitlement benefits with them and buy a replacement property whenever they want. So again, there's a nuance there going on. So just be aware. Moving on, conventional loans. Conventional fixed rate loans, 30-year loans, not assumable. No, they have what's called a due on sale clause in them. And it just basically states that if you sell your home or if you turn your payments over to somebody without the knowledge of the lender, then the lender can go ahead and call the full loan balance due on sell as soon as they find out. So that buyer and that seller may find that a demand for hundreds of thousands of dollars are being made in a very short amount of time. So there's not a lot of buyers that would be willing to go ahead and step in under that kind of risk. Now, conventional adjustable rate mortgages, ARMs, now they may be assumable, but again, you're still going to need to qualify, just as if you're qualifying with today's loans, but it may be worth checking into. Looking at that, it's two different types because we're talking about that due on sale and the risk that's associated with it. The safest type of assumption is called a novation, and that's when you do things above board. You're simply, as the new buyer, bringing an assumable loan, the verbiage, the original loan from the seller to the original lender, and with all the submission documents, they approve you, and once you are approved, again, that seller is released. Perfect. Nice. That's novation. There's also what's called a simple assumption, and that is when you don't bring it in front of the lender. You don't go under the underwriting standards of the lender. However, you still go ahead and take over the payments. Again, there is some risk involved there simply because if it's found out, it's going to be an issue that's going to have to be addressed by both the buyer and the seller under a simple assumption. So there is a good argument, if you will, for going above board with that novation. So it sounds fantastic. It sounds like wonderful. Who wouldn't do it, right? What's the catch? Well, there's a catch. You got to remember, you're just assuming the original loan. That original loan may be 10 years old. So maybe they bought the property for $300,000 and they've got maybe a $200,000 loan that is, has 20 years remaining on it. But today's property value is $600,000. So you got a $200,000 loan and a $600,000 property. There's a $400,000 difference. That seller is going to want their $400,000 equity. So there's the catch. In this particular case, you can't assume that 200 at a very, very low rate. But what are you going to do with that 400? Well, there's a couple of three things you can do. You can get through novation with the assumption, you can go to even that lender and get a home equity line of credit to go ahead and offset that 400 and satisfy the seller. You can get a second mortgage, second lien on the property for 400. You can come in with 400 and just have the 200 assumption, but you can also come in with a seller carryback. Again, that's equity. So there's nothing at all wrong with the seller taking payments through time on that 400 at an interest rate that you guys could negotiate. It's kind of a cool arrangement, really, if you think about it. So that's the catch. You need to address the equity issue. So looking at that, how does it happen? The steps to go ahead and get a loan assumed. Well, first you want to track down a property that you want that has an assumable mortgage. Now, I do have a software that lets me know whether a particular address has an assumable loan or not. So if you are interested in maybe going down this path, just go ahead and contact me and we can start putting together some available properties here locally. Also, you might want to look at maybe some distressed properties, because if a borrower is getting jammed up and they're at risk of foreclosure, they may be more willing to go ahead and have you take over their property and assume their loan. And we'll talk about why that might be an advantage when we talk, if this approach is of interest. Also, you got to remember, though, if you do approach a home that has some payments that have been missed, someone's going to have to make those payments, because that original lender is not going to allow for an assumption of a loan that's in default. So someone's going to have to bring it current. So whether it's going to be part of the negotiations that you bring it current as part of a larger benefit of acquiring that low interest rate, might be the right thing to do. I wanted to go ahead and point that out. So next, you need to actually take a look at the clause in the mortgage, just to make sure that you've got the right verbiage. Now, here's where it gets confusing. Even though it's an FHA, if you're not seeing the clause, does not mean that it's not assumable. So don't assume that if you can't find it, that it's not assumable. Let's go ahead and take a closer look and talk to perhaps the original lender. So Once you got to confirmation of the verbiage in the clause, then it's just simple. It's essentially just applying for a loan as you would with today's lender. It's just going through the underwriting process. The same, paperwork needed, taxes, bank statements, yada yada yada. All that stuff's on my website under the lending. If you want it, it's all there. So next, then you would go ahead and just pay your closing costs as well as how you're going to address that equity issue. Again, that's the catch. If it weren't for the equity issue, everybody and their brother would be just looking for assumable loans in an environment of high interest rates. So we need to have a plan on how we're going to go ahead and tackle that equity. In my next video, I'm going to talk about that a little bit more in depth. There may be actually an advantage to that in certain circumstances. So we'll touch on that in a few. And then finally, once you've got that novation accepted, just go ahead and sign the promissory note, and you are on the hook for that old mortgage. You're going to dust off that old mortgage with the low interest rate that's been about halfway paid off, and you only got maybe halfway left. We're going to talk about in the next video why that is so incredibly valuable. But you did it. Congratulations.